share my screen into the presentation. So you should see the presentation now, and this is taking place. This is really looking at data and research that we've conducted in the first half of 2023. But a lot of this is about our outlook and our capital markets expectations for what comes next. And it's been a very peculiar start to 2023, the first half of 2023, and we'll examine some of that peculiarity in this presentation. Here are some disclosures for you to read thoughtfully. You can press pause if you're watching a recording. In essence, past performance is not a guarantee of future results, and I think we all know that. And this is also not an offer to buy any securities. This truly is an education forum for our clients and our network of advisors. So if you want to stay informed along the way, please do follow us on Instagram and Twitter, and also LinkedIn and YouTube and Facebook. So we're on all the different social media platforms, and you'll certainly get up to minute information on each of those platforms. Anytime there is a Forbes article published, for example, that has a forecast, we're usually sharing that on these various platforms, and including podcasts as well as YouTube videos. And it's just nice, especially when things get pretty volatile and hectic. There will be some resources shared on these different platforms. So a quick flashback to a year ago when we were doing this presentation after the first half of 2022. And we had a slide in that presentation, some of you were attending it, that was titled U.S. Economy, Too Hot to Handle, Too Cold to Hold. And the text in there was economic activity is still above long-term average as consumer behavior begins to wane. Inflation and higher borrowing costs are considered the main drivers to this. So this was essentially what was presented back in that presentation from 2022. And you can see that the weekly economic index, which, by the way, and as a reminder, the weekly economic index is an index of 10 indicators that measure real economic activity. It primarily represents consumer behavior. And so it was sitting at around 3.57, and the three-year average at that point was around 1.56. And you obviously can see it dipped all the way down to -11, all the way up to +11. So quite a bit of volatility due to the pandemic and the post-pandemic period. And so now we see that the weekly economic index, which is really meant to be a very contemporaneous measurement of activity in the U.S. economy. Are we slowing down? Are we speeding up? It has slowed down quite measurably since that period of time, since June of 22. And so this second chart basically picks up where the last one left off. So it absolutely was a downward movement, and we saw it go from about a high of 3.78 all the way down to 1.05. And actually, as of last week, this has ticked up just a little bit to 1.37. So it's not meeting that annual average yet, which has now moved up to about 1.8, and not even at that longer term average of 1.5. So there's still some slowing that may happen. It's a highly volatile metric, as you can see. It does bounce around quite a bit, but there has been a demonstrable downward trend. And again, this is a contemporaneous measurement. So It's just giving us like an EKG. It's telling you the status of the economy now, right now, today. So you really can't use this too much as a forecast, but it really is where you can see the economic slowdown show up in the economy. If you're wondering, oh, are we slowing down? Are we speeding up? This is the index that most economists reference just as a quick hit to see how the economy is doing. And certainly things have been slowing down. So here's, and again, one of the things that we do here at AWAIM is we take a step back, we look at the big picture when it comes to the global economy, global markets, stock markets, bond markets. And because of that, taking a step back, looking at the big picture, we call that global macroeconomic. And so that's really the research we look at. It's what we're very interested in following day to day, week to week, month to month, quarter to quarter. And here's a good example of some interesting data. And this looks all the way back to the end of 2017, beginning of 2018. And you can see that household debt has basically been growing over the past few years, but growing at half the rate of U.S. public debt. U.S. public debt is up over 50%, growing at nearly an 8.5% annualized rate over the past few years, whereas household debt has been growing at about half that rate, 4.08%, or 22% cumulative growth over that period. Why is this important? Well, it's important because when you have more public debt, this means less fiscal policy options. There's just less money that the government has to send to people, to helicopter in, to save people, to bail things out. And so there's a bit of a squeeze right now, and we saw a little bit of drama of that earlier this year with Congress and with the debt ceiling, and it seemed like there was a hostage situation there with our economy, which isn't new. It seems like that happens every time we get close to these things, but it's something to be concerned about. So there may be an indication that we're a bit tapped out. And then even recent figures out of the Treasury showed very, very low collection rates of tax revenues recently. So that's not good. That's not a good equation. If you're taking in less, you're spending more, even just a month out from when Congress had passed that increased spending or increase of the debt ceiling, there's already $1 trillion more of debt that is on the books. So this is something just about optionality. When you have more debt, you have less options when trouble does arise, and that goes also for households. It just means that they have less room for continued spending. And there's a chart here that I'll share with you a little later that is kind of strange that there is this much additional debt, even though income has actually been growing too. I'll share that in a minute. So here's, I think, and certainly we in our investment committee, one of the things that we're really obsessed about is looking at money supply, which is a reflection of the monetary base of the U.S. economy. And this particular metric is called M2. Sounds very scary, sounds very technical. It is not. It's just a measurement of deposits in banks, money market funds, CDs, just readily available, quickly converted cash equivalents. So you can see that over the past few years, going back to May of 2018, all the way through May of 2023, basically the purple line represents the growth of money supply in the United States. So it's basically been 48% cumulative growth or expansion of the monetary base. That's a lot of growth. And you can see most of that came post-pandemic, during that pandemic, just all that helicopter money that was put into the economy, businesses shut down, people, at home. So this was a colossus of an increase. And what's so very interesting is you see this correlation of the US stock market. It's up about 54%. And there generally is this belief that when you have expansion of monetary bases, when more money is circulating within an economy and injected into the economy by the US Treasury and the Federal Reserve machinations that go on there through the banking system, you basically get this phenomenon where prices are really following growth in money supply. This isn't an out there idea. This is widely accepted by many economists that there is a very high correlation between expansionary monetary policies and asset prices. And so we've seen stock prices go up. We saw real estate prices go up. Basically, the price of everything. Bitcoin, was going gangbusters during this entire period of monetary base expansion. And so let's take that a step further. Let's look back to a period of time when the Federal Reserve started to tighten the monetary base, take money out of the US economy. And this happened in the fourth quarter of 2018. And a lot of folks have termed this as the taper tantrum. And so all that occurred during that period, by the way, was a contraction of just 2%, about 2%, 2.17% of the money base. Well, the reaction to that, that's why they call it the taper tantrum, was a drop in the S&P 500 of 19% in that quarter. It was a very, very visceral reaction to it. So generally speaking, the markets do not like it when money is being extracted out of the system. That typically will mean that asset prices will deflate instead of inflate with all that extra money. So let's look at another period. This is a period from March of 2022 when the Federal Reserve began in earnest to contract the money base, to start to take more money out of the system. And you can see there that the net effect was about negative 2.6% change in what the Federal Reserve Bank was holding of assets in its balance sheet. It holds treasury. This is the mechanism by which they remove money from the system. And the market, I guess, maybe the taper tantrum, they kind of, it was truly a tantrum, and they got all of that stuff out of their system. So instead of going down 20%, it only went down about 10%, down 9.29% from the year ending March of 2023. So during that period, there was contraction, the markets followed. So this is all normal. This is the kind of normal thing that you would expect to see. But then something is going on here now. Something's different. March of 2023, which is something else was happening during that time. This was the little mini banking crisis, Silicon Valley Bank, Signature Bank. They had some issues. The FDIC had to step in. The government had to come in. There was a bailout of sorts of depositors and banks. Now those banks gone into receivership. And yet, even though there has been contraction of monetary base during this period of time, and we're just looking through the end of June, so this is just a couple of weeks ago, a 3.38% contraction of the money base, we see the S&P up nearly 7%. So what's going on here? This is different. Anytime you see divergences from established correlations, that should give you pause for thought. So let's take a look at the stock market. Most folks are really interested in the stock market, so of course we're going to talk about it. Here is a chart. It was sourced from Piper Sandler. They show that the percent of S&P 500 stocks that have been beating the index over the trailing 3 months. Basically, we're at a low that we haven't seen since 2000, basically right before the dot-com crash. So what does a market having bad breath, not breath, market has bad breath, what does that really mean? It just means that very few companies are participating directionally movement within that particular market. So there are very few companies that have actually been generating tremendous returns so far this year. Most companies have actually been languishing, not returning very much at all. This is kind of an extraordinary thing to see, that we're really similar to another time of great euphoria and I would even argue delusion when it came to valuations associated with .coms. There were companies getting billion-dollar valuations in 1999 that didn't even have $1 of revenue, that were just business plans. So obviously, I wouldn't say we're in a similar delusional period right now, but there may very well be rhyming aspects of delusion. So you've heard maybe about 7 stocks that really have been driving the S&P 500 return so far year to date. And this is just as of May, and this phenomenon has actually continued as well. There's been a little bit more creeping breadth that we've seen, so a little bit more participation, which would indicate to us that maybe there's an opportunity for some rotation in the markets, which we would not mind. We are positioned favorably for that. However, look at how stunning this is, that really through almost the end of May, just those 7 stocks were up, collectively they were up around 44%. And then the S&P in their weighted form. And then the S&P 500 was up about 10% at that time, but the 493 other companies were up only about 1%. And many of those were actually negative at that point. So think of that disparity, so if you're looking at stocks that you own, if you're looking at your 401k and you own a well-diversified portfolio, you probably have been scratching your head like, well, wait a minute, why is the S&P 500 up so much? Well, this is why. Not only was it back in May, this has continued to be the case. Meta, Amazon, Apple, Microsoft, Google, Tesla, Nvidia, they have contributed the vast majority of the gains to the S&P 500. But all these other participants in the S&P 500 have not benefited from this and haven't had this similar experience. So what's really going on here? Well, we don't really look at it as the Magnificent Seven. People been calling these 7 companies the Magnificent Seven. We see it more like mediocre 7. And why is that? Well, when you actually examine what's going on fundamentally, and this is a circle that highlights the top individual underlying securities within our most aggressive strategy that we offer. Some of those names may be recognizable to you. We look at fundamentals. We want to buy companies that are actually worth what they're selling for in the market. We don't want to overpay for something. I don't think anybody wants to overpay for anything, but oftentimes markets, people end up overpaying for something that is just not worth what it is. And so here's a way of actually looking. Oh, let me put this on. My phone's ringing, sorry. Do not disturb. Okay. See, we're a live, active business around here. Okay. So if you look at earnings per share growth over the past 5 years, these numbers look pretty good. I mean, who would have thought Johnson & Johnson is at a 70% cumulative growth on earnings per share over the past 5 years? I mean, this is just kind of a staple company. I mean, Nestle at 9%, Novo Nordisk. Okay. I mean, United Health Group, 15%, Chevron, 30%, BHP, 41%, ASML, 22%. So there's some good growth here. And then dividends. Yeah, these companies are paying dividends too. Some of them quite significant, like almost 9%, others not so much. Like 1%. But then when you look down at the Alphabets and Microsoft and Apples, you don't see earnings per share growth that really knocks your socks off. I mean, first of all, you don't even see anything above 40%. You get close to 40% with Google, but there's no 70% down here. There's not a lot of, not everything is above 30%. So, and then you look at dividends, which is just ongoing cash flow and companies sharing profit with their shareholders. It's almost non-existent. So, and then PE ratios, you can get into that. But this is certainly not something that we would look at on a fundamental basis and say, oh gosh, we're really missing out on some great value for those stocks that have just really hogged all of the upside benefit and growth so far this year. And others may argue, well, that's because AI is going to revolutionize the world, and these companies are going to benefit the most from that. I don't know how you would come to that conclusion, considering that every major multinational corporation is in some way, shape, or form, by their own reporting, getting involved in AI and leveraging all these different technologies and different companies to do that. So, there's a lot of opportunity for expanding profit margins at companies that may be more analog, and incorporating more digital and AI actually can have even greater impact. So I think that there could be maybe a little bit some exuberance here, particularly in the pricing of those magnificent or mediocre 7. That may be a dynamic. And just to put a finer point on the mediocre 7, looking at the top 10, so we're adding 3 more stocks into the 7, looking at market capitalization, they represent about 32%. The top 10 represent 32% of the S&P 500. And this was as of the end of May, by the way. So this could have expanded just a little bit as well. And then earnings contribution of the top 10 to the S&P 500 is only 21.5%. So, okay, they're worth 32% of the entire S&P 500, but they're only contributing 21.5 to maybe 22%. That is obviously a divergence, and something that is notable, and something that also adds to our thesis that there's some exuberant pricing that's gone into those top stocks, which certainly makes us very wary to hold the S&P 500 market-weighted index. Currently, right now, we don't have exposure to that in any of our formalized portfolio strategies for our clients. We are equal weight exposure, or not market weight exposure. So that's how we're really hedging our risk currently for our client portfolios. So now we're going to shift gears a little bit, and we're going to talk about something referred to as the maturity wall. And the maturity wall is there's a bunch of debt that corporations have issued over the past decade plus that is going to be coming due in the next 12 months, 24 months, 36 months. And you can see this particular chart from S&P Global Ratings. Just in the next 36 months, we're looking at close to $7 trillion that's going to be maturing. A nice chunk of that may be lower grade, but this is a behemoth amount of debt that's coming due. Here's another way to look at it. A lot of debt's coming due, but the area that we're most concerned about, and therefore we have very limited, if any, exposure in this particular area, is in triple Bs. The triple B space, which is this pale blue area, is the biggest component of corporate debt, certainly in the United States. And this area of triple B is something that's quite vulnerable in our estimation, and that is because you can have downgrades that occur from triple B status into double B plus, which is the first tier of the junk bond status. And once you get into junk bond, that's usually when you would then see subsequently some type of default event. So default events are not going to occur in the investment grade spectrum. You'll first see downgrades from triple B, then into double B plus or double B, and then you'll see some default events, missed payments, not returning 100% of principal, those types of events. And the reason why this is so concerning is that several years ago, the debt was very cheap. You were looking at debt, cost of debt for investment grade debt was 1.5%, 2%. Now, when they go to refinance, they're looking at 5, 6, maybe even 7% yield that they're going to have to pay, rates that they're going to have to pay. And so that is a significant increase, doubling, maybe tripling the debt service payments and expenses for these companies. And are they going to be able to do it? Do they have the cash available? Do they have the increase in revenues? Do they have the increase in profit margin? That's a big question mark, and something certainly that we're very, very concerned about and watching very, very closely. This is one of the biggest themes that we're really paying very close attention to. And it's different in different segments of the global economy. The top section of this page shows the U.S. corporation. This is non-financial sectors. So this is just U.S. corporations in the United States. There's about 7.6 trillion that's outstanding out there in debt securities across all the different qualities and ratings. But if you look to Europe, there's only about 1.6 trillion. And it's not like Europe is that much smaller of an economy. They are a smaller economy. They have about the equivalent in population to the US as a group, the Euro bloc. But the economy is, maybe 30-40% smaller, 30% smaller, not this significant of a difference. So the US corporations really binged on debt. They took a lot of it out. And so this to us may indicate some unique challenges and volatility within the US market relative to the developed foreign markets like Europe. One of the reasons why we have more developed non-US exposure in equities than normal. So we are a bit overweight in that area as a result. So here's kind of a sad reality, I suppose, if you want to look at it in that way. The total consumer credit outstanding has grown 47% over the past decade. And at the same time, guess what? So has U.S. disposable personal income. It's grown about 48%, almost in perfect lockstep. So here you have more disposable income being available to consumers, and yet debt has really almost in lockstep. Only a little bit of a blip. Did you see some pay down occurring after the great financial crisis? But what a tremendous amount of debt that has been added on, even though personal income has also been increasing. So there's probably a reason for that. And one of the driving reasons that we point to is that the consumer price index, just the price of all things, has gone up substantially. And even though you probably have heard the latest inflation print, the latest number in inflation year over year was somewhere around 4%, and everyone gets very excited that that number is dropping. Year over year rate, it's getting slower. Well, guess what? It's still inflation. Inflation is still occurring. And so you've actually stepped back and you look at the cumulative amount of inflation just since May of 2020. So just a little over 3 years, you're seeing about 18.5% increase in prices within the US economy. That's a huge amount. Meanwhile, disposable personal income is up just about 9.5%. So there is a big lag here. This is a big differential, and this is a squeeze. So people are feeling the squeeze. This is real. Income has not grown on a real basis, on an inflation-adjusted basis. It's negative, and so this is certainly a challenge for consumers. It's one of the reasons why we think there's the consumer credit is continuing to go up. People are relying on their credit cards to really meet that inflationary expense. And just to belabor a point a little bit, is looking at consumers versus stocks. You can look at retail sales and the S&P 500 level change, and you can see over the past year, this is May to May, they've basically been identical, only about 1% return in the S&P 500 in terms of level change, and U.S. retail sales are up less than 1%. And then for June, since this is as of May, we saw that the year-over-year retail sales were 0.54, so actually ticking down a little bit. So this is certainly representative of the majority of discretionary spending. That's what these retail sales indicate. So this also gives us a bit of a pause for thought, makes us a little bit more concerned about all of that price inflation in stocks, and certainly the very few at the top that have been carrying that S&P 500. Shifting gears to real estate. Many of you have homes, and many of you have second, maybe even third homes. And this is a very dramatic statistic that Redfin published. There are many investors, both large institutional investors and also just households, that have bought second, third, fourth homes and have Airbnb'd them, VBRO them, and that has essentially come to a screeching halt. Well, it's down almost 50% year over year. So this is a dynamic that certainly is indicative of a change in appetite, no doubt about it. And obviously interest rates, much higher mortgage rates and financing costs have played a big role in this. And also just vacancies. People have bought Airbnbs thinking that they would have perennial, all the time occupancy. That isn't happening. Now you have major metropolitan areas seeing vacancy rates that go on quite a while, and people are having to meet those debt service obligations without having any income, and no one is renting those properties. So this is another area of something that we will continue to be watching, but something quite indicative. And early in 2023, I wrote a Forbes article talking about watching real estate as an indication of the health of the economy and where things may be headed directionally. This certainly is in that category of something not to be so excited about. And also, when you look at labor force participation, you can see that there are millions still out of work relative to pre-pandemic times. We're sitting at about a 62.6% labor force participation rate. This was as of May. The number has not changed for June. So this is something certainly the Federal Reserve is looking at very closely as well when they're figuring out their rate hikes and whether more is needed. We would expect that we would not see increase in labor force participation. We would expect that as interest rates are at these higher levels, businesses are going to be looking for ways to meet those increased expenses of debt and therefore continue to reduce payrolls. And we've seen a little bit of that so far. The last part of this is talking about the very phenomenal yield curve inversion that's underway. Yield curve inversion sounds really technical and very scary. Essentially, all it is taking the difference between the 2-year Treasury yield and the 10-year Treasury yield and seeing how much higher the 2-year is relative to the 10-year. And so when short-term rates are significantly higher than longer-term rates, you get this inversion. It's actually very unhealthy for the markets, very unhealthy for the economy. No one is incentivized to loan money over long periods of time if they get less return on that. Longer periods of time have more uncertainty. Therefore, you should demand higher rates of return. Right now, the markets are not doing that. Very short periods of time are providing the higher rates of return. So that is a problem. And you can see, I mean, this is as plain as day. We're at about a 1% or 100 basis point inversion. And that's quite significant. And you have to go all the way back, basically, to the 80s to see something so significant. And you kind of got close in the 90s and the 2000s, right before the great financial crisis. But you really haven't seen it at this depth since the 80s. So that is certainly quite concerning. And it's been going on for a long time. And it's really confounded many economists why we are not in a very severe recession by now. Our estimation is because there was just so much cash that people were able to save during the pandemic period. And so the economy has basically been subsisting off of that during this subsequent period. And the final point to make in this presentation, thank you for joining me, by the way, is that when we really try to understand where do we want to be allocating client capital, where is a good deal to be had, we look at something that refers to the equity risk premium. And there's a way to do that, to see, well, how much extra return am I going to be getting from stocks relative to a risk-free rate like a US Treasury bond? Well, this is a chart that shows you the earnings yield. So this is the S&P 500 earnings yield. All the earnings yield is the inversion of the PE ratio. Most people have heard of the PE ratio. It's price over earnings per share. If you invert that, you get earnings per share over price. And that essentially, many great thinkers like Dr. Jeremy Siegel out of the Wharton School believes that the earnings yield represents the long-term return for stocks. Well, right now, that figure is around 3.38%. And I'm using the Shiller version of this, which takes a cyclically adjusted figure, which averages out earnings over the prior 10 years. It's maybe a more conservative way to do it, but essentially, it is indicating about a 3.38% earnings yield, or Siegel might look at this and say a 3.38% long-term return for U.S. stocks, specifically the S&P 500. Whereas the 2-year Treasury rate right now, or as of the end of June, was paying 4.71. Right now, that's paying 4.74, so it's gone up a little bit more. And the cyclically adjusted earnings yield for July is down even further. It's down to 3.25 from 3.38. The only times we've seen this before are just before the pandemic in basically 2019, and then right before the great financial crisis. That is really where we saw something quite similar. And so this is certainly something that concerns us and really gives us extra conviction to be even more defensive, which is why our equity allocations are hugging the lower bound of our mandates. So if it's a 60% neutral weighting to equities in one of our strategies, we're now at 50%. So we're really just taking a lot of chips off the table, and we had already done that coming into this year because a lot of this data had already been indicated. Thank you so very much for joining me. And of course, you can scan this QR code and visit our website where regular updates are provided, or email us at info@AlignWealthLLC anytime, and we're always happy to continue this conversation.